Hello, everybody, and welcome to this Tresle webinar. My name is Joel Keeler. I'm the CEO of Tresle, and I have a very exciting presentation for you guys today. Before I get started and introduce today's guests, I want to briefly give an overview of what we'll be covering today. So this webinar is going to be all about the SBA loan. In other words, the Small Business Administration loan, as an option for financing the purchase of a private business. So many of you have maybe already heard the term SBA loan, but perhaps want to learn a little bit more about its benefits, its structure, and some of the details that come with it. If you're completely new to the topic, don't worry, you're still in the right place. So today's format will begin with an interview with our guest, and then we're going to transition into a Q&A of questions that were pre-submitted through social media, followed by a brief close and next steps. So without further ado, joining us today is Jack Postregna. He's the VP of SBA Financing and Lending at CrediBench by First Home Bank, headquartered in St. Petersburg, Florida. Jack and his team at First Home Bank consistently rank as one of the top SBA lenders in the nation. And Jack brings a wealth of knowledge in the space and will be a wonderful resource for today's webinar. So thanks for joining us, Jack.
Thank you for allowing me to be here.
Yeah, so maybe we could get started. Tell me a little bit about yourself, your background, and how long you've been involved in SBA lending.
Sure, that'd be great. Again, my name is Jack Postregna. I'm with CrediBench by First Home Bank. CrediBench is it's an SBA division within First Home Bank. We are a top 10 lender in the nation, as you mentioned. We're a preferred lender, and we actually have a nationwide footprint, so we can lend anywhere in the United States. Personally, I'm actually approaching my 21st year in SBA lending. And during that time, I've been involved in helping a lot of individuals really fulfill their dreams by giving them an opportunity to own their own business.
Okay, awesome. Yeah, that's lovely. And maybe you could touch on a little bit about how you guys at CrediBench by First Home Bank approach SBA loans.
Yeah, we take a holistic approach to looking at each opportunity and deal. There really is no one-size-fits-all approach that we use. We do want to understand the deal completely so we can provide the best guidance to our clients and structure and possibility for approval.
Okay, yeah, and so let's dig right into today's topic. So at a high level, what is an SBA loan? Specifically, I know there's different divisions, but specifically as it relates to acquisitions, maybe what makes it unique?
Sure. Yeah, the SBA loan program itself is the SBA's primary program for providing financial assistance to small businesses. SBA 7A loans come with a government guarantee of 75%, which allows banks to get more comfortable lending on business acquisition transactions, as they can sometimes present higher risk to the bank.
Okay, so on the consumer side, i.e., the person going out to get that financing, what are some of the benefits compared to potentially the other forms that are out there?
Yeah, there's a lot of benefits to the SBA loans. We have smaller down payments, lower monthly payments, longer and more flexible terms, in most cases 10 to 25 years. There isn't any balloon payments. They are fully amortizing loans. We can do up to 90% financing on some cases. And then lastly, soft costs such as goodwill, closing costs, and franchise fees are eligible. So a number of different benefits for the 7A loans.
Yeah, that's awesome. And can you touch a little bit, just for those who aren't familiar with what the no balloon element kind of entitles?
Sure. Yeah, and on traditional bank loans, they will sometimes have a balloon note that needs to be paid off. The SBA loan is actually fully amortizing with no balloon payment. So basically, each month you're going to have that set monthly payment, and then at the expiration of the loan, there won't be any additional payment that needs to be made to pay off the loan.
Okay. Yeah, great. And you mentioned, up to 90% financing in some cases. So, that would mean essentially in layman's term, like 10% down. Am I correct?
Correct.
Yeah. And speaking of that, you said up to that value. What is the typical deal structure that you guys see? So like the amount down, maybe we can talk about seller financing and stuff to that.
Yeah. I mean, as it relates to business acquisition deals, a typical structure would be a 10-year term at 6% would be standard pricing. There would be no prepayment penalty. And typically we see a 20% injection as pretty much a standard on most deals.
Okay. And so maybe let's walk through that example with like, say, a business price of, let's say, $1 million total.
Yep.
So how would that look, I guess?
So yeah, the way that the structure would look on a $1 million purchase is we'd have, first of all, it'd be, as long as it's just business assets only and there isn't commercial real estate, it would be a 10-year term. We would have it somewhere around 6%, no prepayment penalty. On $1 million business, we might want to seek a larger equity injection or a larger down payment than 10%. And the reason being is because most likely if it's an asset light business, there's going to be some goodwill there that we have to mitigate. So in most cases, we would want our borrower to bring in a little bit more equity to offset that goodwill weakness of the deal.
Okay. Yeah, no, thank you for that. And of the deals that, let's say you guys see, what's the typical size?
Yeah, our transactions are, anywhere from $100,000 minimum all the way up to 5 million. So it's a wide spectrum. I'd say our average deal size is around 750 grand.
Okay. And what industries are there restrictions in terms of that? You mentioned, goodwill, you mentioned the balance of assets, potentially certain industries lend itself to have, different balances. Is there kind of, I guess, red tape around that or guidelines of structure that you guys have around that?
Yeah, I mean, we try to stay open to all concepts and industries and lending to all of them. Obviously with COVID here, I mean, there are going to be industries that we have to be more cautious, i.e. restaurants, fitness, hospitality, those types of industries right now are experiencing, a lot of challenges. So yeah, they become more difficult to finance during this time. But really, we try and stay as open as possible to financing all the industries that are out there, and really all the concepts, the franchise concepts, as long as they're approved by the SBA registry, we'll consider them.
Okay. Yeah. So relatively agnostic then, right?
Yep.
Okay. So on kind of looking at the buy side, obviously there's going to be benchmarks that you guys look at in terms of criteria for acceptance. Can you maybe give, a little bit of an example of what that looks like for your typical, individual who's looking to buy a private company?
Sure. Yeah. There's definitely some criteria that we look at, when we're looking at buyers. The first thing I would say is we look at and ensure that they have good personal credit. And usually our benchmark is around 700. As long as they have over 700, that's a pretty good indication that they've made their payments on time and stuff like that. We don't want to see really derogatories, late payments, high utilization, bankruptcies and foreclosures can obviously be a problem. Criminal background of an individual could be a problem as well with this government guaranteed loan. A second thing that we look at is liquidity. This is important. We make sure that they have sufficient cash flow, cash on hand to inject into the deal as a down payment. 10% of the project cost is a minimum. We talked a little bit about that earlier. 20% is more traditional on a SBA loan. Third thing we look for is collateral. On deals that are less than 350, the SBA does not require collateral. On deals that are over 350, they do require collateral to be pledged.
Okay, and let me just interrupt
Yep.
you there. Maybe you could give an example, of a typical collateral, like what that means.
Yeah, a typical collateral would be hard assets. So
Okay.
A primary residence, a rental property, land, or marketable securities, those would all be considered collateral that
Okay.
we would consider.
Okay, awesome. Yeah, as you were saying. Sorry.
And then lastly, we look at the business and we want to make sure that the business is able to demonstrate that they have sufficient cash flow to support the debt, to be able to pay the bank back, right? So debt service coverage ratios, minimum 1.15, and then we would prefer to see debt service coverage ratios of 1.25 or higher. 1-to-1 would just be the business paying the loan back and not having anything additional.
Yeah.
So 1.25 is what the bank would seek.
Okay. So, is it also important, I guess, I've also heard before that, it's important to have experience if you are the borrower. Does that affect one's ability to seek out financing?
Absolutely. Yeah, absolutely. We require a resume. The SBA requires a resume to be provided by the operator. We do like to see direct experience in the industry that they're buying into. There's going to be occasions where they might not have it, direct experience. Then we want to look at their resume and go, okay, do they have prior business ownership experience? Have they been in a senior level position where they're managing a P&L and balance sheet, and we can get kind of comfortable with their skill sets that they have. So it really just kind of depends. Everything is kind of a case-by-case basis.
Yeah.
But for the most part, we look for direct experience in the industry that they're buying into.
Yeah, it's kind of not really a line in the sand, really, from what I gather. It's kind of understanding, is this person in combination with all the other facets, the check boxes that they fulfill, like, is this person going to be able to hop in behind the driver's seat and have a reasonable amount of skill or experience to kind of drive that ship forward, because there is that transition in ownership, correct?
Yep, exactly. And if there's a deficiency in the experience, let's call it bucket, what I'll do is I'll typically go back to the borrower and say, look, I'm having a problem being able to correlate what you've done in your past versus what you're looking to go into. So maybe tell me how you think your skills can correlate into this business that you're buying, and tell me why you're passionate about it. And I'll have them put in like a paragraph or two to explain that. And I'll just use that as an addendum to their resume when I go and put it into underwriting, to be able to share with the analyst and say, here's where, I got comfortable with their experience. They put this together.
Okay. Yeah, no, that's awesome. And, I guess speaking of kind of that journey that the borrower is going to take, maybe you could touch on the timeline. Let's assume, on day one, I'm seeking out to borrow funds to purchase a business. Kind of walk us through, you mentioned the term underwriting, so that's kind of a phase in the process. Maybe you could touch on kind of that life cycle, maybe from start to finish, the timeline, as well as kind of each stage, and kind of approximate. Obviously it's case by case, and there can be some issues that potentially speed it up and slow it down, but just on average.
Yeah, the borrower, what I would do first, I would pre-qualify the operator, the individual, the borrower. And what I would ask for would be an application completed, 3 years of tax returns on them, a resume, and 2 months of bank statements. When I receive that from them, I should be able to pre-qualify them the same day. So really the pre-qualifications for the most part are same day, as soon as I get the loan package from that individual. So they're able to see my terms, my conditions, everything's on there. It's a non-commitment to lend, meaning that you can't hold me to it because we haven't gone into underwriting, but this is what I would propose based on what I've reviewed. If they like the terms and conditions, they would sign that pre-qualification and move forward with an expense deposit. And then we would get them into underwriting. That timeline for formal approval is typically 2 weeks for a formal commitment. And then after that, we would close 20 days after the formal commitment. So really on a business acquisition where there's not commercial real estate, we're closing those anywhere from 30 to 35 days from start to finish. We've done them sooner. They've taken longer. It really just depends on the particular situation and how quickly and motivated the buyer is to really send in some of the items. And then businesses that do have commercial real estate that are being purchased, those are somewhere between 35 and 45 days, what we quote. And the reason being is, we got to do a commercial appraisal. There's environmentals. There's other third-party things like titling that they have to do that takes a little bit longer than your normal business-only purchase.
Yeah, absolutely. So you mentioned a good point about kind of the pre-approval being the first component of that. So, I understand they're not the same thing, but I think for a lot of folks, it's good to kind of pull that comparison in terms of like with a mortgage and potentially something that folks are really familiar with. So I guess my next question is around, at what point should one, from the borrower's side, kind of start to seek out, pre-approval? Is it, after they found the house, in other words, the business, or is it, when they're starting off their journey of like, oh, I want to buy a business in this neck of the woods or this industry? Kind of where in that realm do you suggest they get started? And then part two of that question is, how does it help their position compared to, a business owner who gets offer A and offer B, one with pre-approval, one versus, I'm just interested.
Mm-hmm. So yeah, that's a great question. So, I get a lot of borrowers reaching out to me, or interested applicants reaching out to me, and not knowing how much they can qualify for. So that's always a good starting point. Let's get a personal financial statement on you. Let's get a resume on you. Just for starters, I'll be able to identify what we can qualify you up to. I'm not going to ask for a whole loan package up front, but at least this way I'll give you a figure on where you can start to look for businesses and what that purchase price would be. So that's a great starting point. I can do that same day as soon as they provide the PFS and their resume. Really what I'm looking for is how much liquidity they have to inject, and then is their experience matching the business that they're looking to go into. So that's what I'm determining by doing that kind of pre-screen for them. Most of the buyers that come to me already typically know kind of what general, where they're kind of going with their purchase price or what they're capable of doing. So really, I start the pre-qualification process with them after they've already identified the business, and really after they've signed an LOI or a letter of intent, meaning that they've agreed with the seller to a certain purchase price. That makes it really easy for me, because then I can literally do the cash flow analysis and make it pretty simple to know whether they're going to be qualified or not. But, some of them do come before that step. They're starting off very preliminary. They don't know how much they can qualify for. So I'm open to either one. If you're pre-LOI or letter of intent, I can help you out and get you pre-qualified. If you're post-LOI and you've already agreed to a purchase price, I can help you from that point forward too. Typically, we will not go into full-blown underwriting unless we have a letter of intent or some type of asset purchase agreement, stock purchase agreement. That way, we know that both parties have agreed, and we're not just hypothetically going into underwriting. So
yeah. So I understand that, it's important to obviously know, and a lot of folks potentially don't know, what price range they've even consider. So, obviously that's an important element of going out and seeing what your bite size is, so to speak. So if I understand correctly, you're kind of seeing based off of their liquidity and their financial position, and obviously in combination with the revenue, you're kind of foreshadowing, okay, I think that they've probably, based on what I've seen, they probably qualify for, if again, that bucket is fulfilled, probably qualify for X purchase price, and you feel relatively comfortable kind of going out and starting that process.
Yeah, absolutely. Absolutely. And then, to answer your second question, these pre-qualifications really, they help the buyers get in a position to where they can work with the business brokers and let them know, hey, I got a pre-qualification from a bank. They're willing to support me. Here's what I can get supported up to. So it really demonstrates some confidence and that they've taken the necessary steps to get pre-qualified with a bank, and they're serious. So I think that helps with the whole process.
Yeah, and probably the broker or the seller looks at it like, okay, you have your stars aligned, you have your everything organized, and we can not waste our time going down this journey with you to find out that you're not even in the right ballpark, so to speak.
Exactly. You've taken the necessary steps, and a bank is supporting you. We realize that they're going to have to go into underwriting and get a little bit more things finalized, but for the most part, they're willing to support you, and you've obviously sent them the paperwork that they need to provide that pre-qualification.
Yeah. Okay. Awesome. Well, this actually concludes the kind of the interview part of our discussion. We're going to now kind of transition into a few, not all of them, but a few of the questions that we received over social media. So I'm going to kind of shoot them over to you. So at BV Moraes asks, how has COVID impacted granting loans to people? If yes, how?
Yeah, I mean, it certainly has. It's a challenging environment right now. I would say COVID-19 it's changed how SBA lenders really consider deals. There's a really strong focus on 2020 financials, specifically the month-to-month income statements and how they compare to the prior year, same time period. Really, the focus is to ensure the business is operating at equal or better levels in the most recent months. This would demonstrate that the business has remedied the pandemic and that they're eligible for SBA financing. So yeah, I mean, when we look at deals now, we ask for 3 years of historical tax returns, but that's not enough. I mean, we need to really see what happened 2020. We need to see what happened this year. A lot of businesses, I mean, almost all the businesses we look at, they've been heavily impacted in that, call it April, May area, March, April, May area. So we're used to seeing a dent in that particular time period. But what's really important is to see that they recovered and that they've came out of it and they're operating at equal or better levels in those recent months. And by recent months, I mean November, October.
Yeah, and for reference, we're recording right now, it's December 2020.
Yeah.
So kind of as you're getting into Q3, Q4, we're hoping to see an upswing, and potentially, depending on the type of business, future purchase orders or future reasonable projections into 2021 that are, we're still not closed down, we're still not on lockdown. So kind of hoping that it's on an upward trajectory. That's kind of the
Exactly. We're also required by the SBA to actually send them out a COVID questionnaire, and that's to the seller. And it's a 5-question COVID questionnaire that asks questions like, are you fully operational? Have you remedied the pandemic? If you haven't, what is your current situation? What kind of things are you doing to remedy the pandemic and get your business back to operating at equal or better levels. So yeah, I mean, they're basically certifying with the questionnaire that, they're coming back and they've remedied it. So, but yeah, it's definitely changed really how we look at deals going forward.
Yeah, totally. Definitely unexpected times, to say the least, if you were to ask people back in January, February this year.
One thing that they do too, Joel, or one thing they've asked us to do, the SBA, is they've also asked us to get projections on any acquisition now, any change of ownership. So that's another thing that's new. And the reason why is because with that change of ownership, they want to be able to demonstrate, okay, well, what's that new borrower? What are they forecasting? What does their pro forma looks like? And then they want some justifications behind that. The assumptions is what they call it, behind it, to go ahead and support it. That way we can kind of look back historically, we can look at 2020, and then we can look at a forecast to see, okay, this new owner, once that change of ownership happens, what's it going to look like going forward, and what can they project? So I think that's an important part.
Yeah, and arguably probably from the SBA's perspective, kind of probably the most important part, because that's the part, post closing into the future, that's the part that they're, lending against and are exposed on. So that definitely aligns and makes sense. So I know you've probably been faced with a ton of pandemic related questions, but I do have another one from Michael at Michael W. How are the PPP loans being looked at as it relates to acquisition? So maybe if you could also, on one hand, quickly give a background of what the PPP loans are, and then your input on the question.
Sure. Yeah. The PPP loans are the Payment Protection Program is what it stands for, and basically they're the loans that help out small businesses specifically to keep their employees on and keep them sustained and working. So those monies are carved out to be able to help them keep their employees on and keep their small businesses open. We were heavily involved in the PPP arena. In fact, we closed just shy of $1 billion in PPP loans. So we were a very big player. One thing unique about us, Joel, is that we not only did it for our customers, but we did it for non-customers. And so unlike a lot of the banks that were, lending these types of products or this product out, they would only lend to, a lot of the banks would only lend to their customers. And we decided that, look, we're going to open this up to everybody. We're going to do it nationwide, and we're going to help as many small businesses, not only in our community, but nationwide that we can. We're very proud of, the accolades that we got from being able to fund that many PPP loans and to help out those small businesses. We did estimate that we saved over 100,000 jobs, which is great. And we actually did 8 times as many PPP loans as any bank in our region of that size. So that was a busy time for us.
Yeah. Could imagine.
To get back at your question, we're seeing almost every acquisition we're looking at, we're seeing a PPP loan, on the books. We do have a process that we have, which is nice, to be able to do an acquisition, even though there is a PPP loan on the books for that business that's being acquired. So we do have a protocol and a process internally for our bank. If we determine that one of the businesses that we have a PPP loan out on, if they're being acquired, and what that process is. So I think every bank's process is a little bit different. So, I guess that my advice or suggestion is, if you're looking to buy a business that has a PPP loan, you'd want the seller to start working with their bank immediately, letting them know that they're selling their business, first of all, what the protocol is, on being able to sell the business with the loan outstanding. So
yeah, because that's one of the main, I guess, areas of uncertainty that our audience and some of our customers have come across in terms of on the sell side, is kind of an understanding of what's kind of unique about the PPP loan is that in some cases it can be forgiven, in some cases potentially not, and there's kind of some cloudiness that I think a lot of folks are experiencing on that front, and making it feel at least a little bit uneasy on that front. So suggestion, you said, is just to kind of get the cards on the table, say, okay, speak with your bank, say whoever issued the PPP loan, and say, this is what happened, this is what I want to plan to happen in terms of an exit or selling, what needs to be done in terms of paperwork, in terms of documenting it, and so on and so forth, and just being really upfront, so it's not kind of discovered down the road, or it could be a potentially a deal killer, or kind of a deal delayer in a sense, right?
Yep, it could do either, but yeah, it's definitely going to delay the deal if it's not addressed on the front end. So yeah, I mean that seller wants to let that bank know immediately that their business is being acquired and what that protocol is internally for that bank. so that way they can satisfy it.
Okay. Yeah, awesome. A couple more. At T Tarwin 67 asks, and this is pretty similar to a question that you addressed before, is, what is the SBA's relation to the lenders, such as yourself or other institutions or banks? SBA being, a government agency, the lender, and kind of how that flows together. If you kind of touched on it in your first answer above, but maybe you could kind of talk about that relationship and
Sure.
how that affects the flow.
Our bank and as well SBA lenders in general, we're the ones that make the loans, but we follow the guidelines by the SBA, and that's the way all SBA lenders are. The SBA provides the government guarantee, which is the 75% on 7A loans. And that's what gets us comfortable with doing, as an example, business acquisitions, which present higher risks to the bank. Well, with that government guarantee, our credit team can get more comfortable knowing, okay, God forbid if something happens, we have this guarantee to fall back on. So we're not totally exposed to the whole entire transaction. That's why you're going to see that with SBA loans, they're more flexible, they're more widely used on transactions that may not qualify for traditional financing.
Okay, yeah, no, that makes sense. At Nick Jamal asks, what methods do you guys use mainly for valuation? Is it DCF, so discounted cash flow, enough to give an accurate picture of the value of the business? How do you look at businesses individually? Why or why not?
Yeah, so our valuations are handled by third-party companies, and they specialize in valuations for SBA loans. They utilize multiple methods, which involve full and an objective assessment of basically every piece of the company. The business valuation calculations typically include the worth of the equipment, the inventory, the property, if there is liquid assets, and anything of really any kind of economic value that the company owns. So that's how our valuations work. We basically have that third party assisting us. Now, what typically happens is our analyst will have kind of a breakdown of what the multiple should be for that particular industry and has kind of a general idea of what that business is worth and will underwrite to it. And then when we go and we get it approved, it'll be subject to a third-party business valuation where they reconfirm how that underwriter, what they underwrote the business to in terms of value.
So kind of cross-reference and double-check, so to speak.
Exactly. It's kind of like a double valuation in a way. One internally and then one from an outside third party. And we have approved vendors. We have approved valuation companies that we utilize. And again, they utilize a multitude of different methods.
Okay, awesome. And this is kind of a piggyback on that question. And it's, with companies, you mentioned kind of the cash to support the debt servicing before. And this kind of ties into valuations in terms of, how is it looked at in the sense of a company that potentially has, reinvested a lot, has potential IP in the sense of, let's say you're looking at a technology company or a company that has a brand value, a company that has, patents and stuff of that nature. How is that taken into account? Potentially the cash doesn't so much meet, the market price, so to speak, that somebody's willing to pay for it. How is that looked at?
Well, yeah, I mean, that's where they kind of look at it on a case-by-case basis. If it's not strictly just a cash flow deal that they can back into and get comfortable with, there's a lot of different other methods that they can utilize to be able to come up with that value. It really just depends on the deal and the makeup of the deal, and then they help us with determining what that value is. But for the most part, banks are cash flow lenders. So we get comfortable with cash flow. We can kind of do a cash flow analysis and determine, okay, does this work at this purchase price? because typically when we see that a business doesn't cash flow sufficiently, it's because it's overpriced. So, that's kind of a little bit of an indicator. It's not always the indicator, but in most cases, if it is overpriced, when we do our cash flow analysis, it won't be over 1-to-1, I guess is what I'm trying to say.
Yeah.
We won't be able to repay its debt.
Yeah, sure. Okay, that makes sense. Last one from the social media poll at Brady12567 asks, can I have a seller carry a second loan on the percentage of the what would be a typical down payment on a transaction? So they give an example of 10% down. Could they get the seller to kind of foot the 10% down of the transaction, or be at the 20% down of the transaction, essentially making them not have any skin in the game. So thank you. An answer to that.
The quick answer on this one is no. We want to see buyer down payment participation on an SBA loan. The minimum a buyer can bring in is 5%, with the understanding that we would need the seller to carry the other 5% and have it on full standby of principal and interest payments until the expiration of the SBA loan. So we can do the buyer can come in with 5%, but that seller needs to carry the other 5%, and he's not going to be able to get his 5% until the expiration of the SBA loan. Now, it will accrue interest during that period, but it will not be paid out until after the expiration of the SBA loan. That's the only way we can get the seller note to count as equity along with our buyer's 5%.
And that seller 5% probably comes with the same relationship in terms of liability and a personal guarantee and collateral. Is that the case?
I mean, it can. Typically we typically see an attorney draw up a promissory note.
Okay.
And that promissory note, goes through in detail, the amounts and what the details of that note, for instance, the term, the rate, when it will be paid out, and so on. So everything is signed off by both parties. And that's typically what we see. But 5%, one thing I want to say, 10% injections or minimum 10% injections, like 90% financing, those really are not the standard for the business acquisition transactions. We really reserve those for well-qualified buyers, because you're really talking about, being exposed to the deal 90%. And you got to have some kind of mitigants, that buyer's got to have a strong background, good experience, or maybe they have good liquidity, good personal credit, good collateral. We gotta be able to show that 10% injection that we're gonna approve them for, we can back it up, and that they're
highly leveraged scenario, and you have to have that 10% has to pack a punch in terms of basically being qualified and justified that that the bank is going to lend the remaining 90, which is obviously a big portion. So
exactly, yeah. So I mean, it is the minimum criteria, and I think that's kind of a misunderstanding in our industry. Is everybody thinks they can just get in at 10% because that's the minimum, but in reality, we want to set the bar up for the best case scenario. We want to get them approved, right? I mean, we all want it approved, but if they have that mindset that, well, minimum is 10%, so I can do that. Not always in all cases. We want to make sure that, we're putting our best foot forward and putting a deal that it makes sense. Not only for the borrower, but for the bank as well.
And sets everybody up, the lender, the future owner, meaning the buyer, and the business being bought, successful moving forward as well.
Yep. Agreed.
Yeah. Okay. Awesome. So that actually wraps up, our social media questionnaire and Q&A. Thank you to everybody that submitted a question. Though we're unable to address every single question, everybody that participated, it's greatly appreciated. So in closing, Jack, I'd like to conclude by seeing if there's any questions I neglected to ask, or if there's any messages you'd like to share with the audience.
If anybody wants to reach out to me, I'm sure you'll provide my contact information, both email and phone. I'm happy to help you on structuring an SBA loan. If you have questions, additional questions that we didn't cover today, feel free to reach out to me. I'm happy to help. Thanks to you, Joel, for today, and also thanks for Tresle. I appreciate you allowing me to do this webinar with you guys today.
Yeah, it's been a lot of fun, and we appreciate you carving out the time to provide a lot of insight on today's topic. I think it'll be very well received, and thank you very much. And lastly, I'd like to thank those tuning in today's webinar. If you're looking for more information on buying and selling private companies, check out our tools, resources, and blog at tresle.com, tresle.com. I'll also include Jack, your information as well. Further, if you have any other suggestions for future webinars or guests, drop us an email at hello@tresle.com. And thank you guys all so much, and stay safe. Thank you.
Thanks, Joel. Thanks, everybody.